Jumping jacks, tax, got my taxes jumping. Now my bag coming with that major money. Dripping blessings, just might buy a house for my mama. Bad credit, don't even sweat it. Cause they'll repair it, ain't no question. They can do it, it's a major movement.
What's up, y'all? It's Prince Donnell, and you are officially listening to $1 Million Life Lessons, where I drop $1 million gems each episode, and it's your job to pick them up. And of course, I'm here, my right-hand man, the man with the cam,
Ron Vann Dam.
And we got a special guest today.
Bianca.
We got Bianca in the building. A lot of y'all have saw her all over social media, and y'all might have recently seen her in the Busted Challenge Jumping Jack Tax Edition. That's currently trending all over the internet right now. So nice to have you on, Bianca.
Thank you for having me today.
Absolutely. So let's go ahead and get into it. Today, what we're going to be talking about is life insurance. So before we even get into it, for everyone who's been following along the journey, you know that I just started Jack Life, which is our life insurance brokerage. And, we've been receiving a lot of questions since then surrounding life insurance because a lot of folks aren't really educated in it. And it's something that I wanted to dedicate an entire episode on to be able to help you with understanding. More importantly, before we get into it, of course, it's tax season right now. So please make sure you download the Jumping Jack Tax app so you can find a virtual financial professional in your area. We have a ton of black and brown professionals that you can connect with, talk to, get your questions answered, and also get your taxes done virtually. So download the Jumping Jack Tax app. We are the fastest growing black-owned tax franchise in the country, which I'm very, very excited and proud of. So with that said, let's go ahead and get into it. Oh, one more thing. I'm sorry, y'all. If you support us, please make sure that you share this podcast on Facebook, Instagram, Snapchat, TikTok, all the channels. Share this. And more importantly, leave a review. If this podcast has really changed your life, all I need you to do is go to the Apple Podcast store, go to Apple Podcasts, or go to Spotify, and please leave a review so that we can continue to get the podcast in front of more people so that they can get this information. Let's go ahead and jump into it. So what's up? What's up, y'all?
Yeah, so to be quite honest, I don't have life insurance. So this is a perfect podcast for me to actually be on and ask some authentic questions that some of you guys also may have. So I can actually start out. I kind of know the answer, but I actually want you to give it to me as if I was 5 years younger, because this will be a serious question. Why should I even buy life insurance?
Yeah. So watch me explain the power of life insurance in 12 simple words. You ready? If I die too soon, my newborn son is a millionaire. That's simple. That's the power of life insurance. It doesn't matter if you grew up in poverty, if you come from the hood, or if your family didn't have anything. With the power of life insurance, guaranteeing your death, you're able to transfer wealth tax-free to your heirs or your beneficiaries off of something that's guaranteed to happen to you. So with that said, I don't understand why a lot of people in our community don't do it when this could literally change the trajectory of all of our families within the next 100 years. That simple concept. So for me, when my son was born a couple days ago, I took a policy out on myself, a term life insurance policy, which I'll talk about in a second. I took $1 million term life insurance policy out on myself. Literally cost me about $80 for 30 years. And now, if anything happens to me, which God forbid it doesn't, but if it does, because as men, we need to get our affairs in order, my son becomes a millionaire. His life changed. The way that I grew up and the way that he is going to grow up are going to be totally different experiences. And regardless of if he has the financial knowledge or not, it's about the fact that he at least has the resource. And that's something that many folks in our community don't have. And life insurance provides us with the ability to do so. So just to reiterate again, me explaining life insurance in 12 simple words. If I die too soon, my newborn son is a millionaire. And we all need to tap into that concept that life insurance is is one of the easiest ways to transfer generational wealth, multi-generational wealth, to your heirs, tax-free, by the way. It's a no-brainer.
So would it be wrong for me to assume that my family before me or my ancestors did not have life insurance, simply are kind of still born into a situation where generational wealth is not a common thing?
So I'll tell you what normally happens. So a lot of times, and I've seen this because when we were inside of our Jumping Jack tax office, I sat down with a few clients, and just through having conversations with them, I go into that conversation like, hey, do you have any life insurance? And a lot of them are like, no. And the issue behind it is that, number one, we're not educated enough around life insurance. There's a few things. Number one, we're not educated enough around life insurance. Number two, many of us have life insurance through our jobs, which that's a group insurance plan, which that's nowhere near enough insurance, and you end up losing the insurance if you leave your job most times. Or number three, you finally wake up around 40 to 50 something years old, and then you have a family and you're saying to yourself, I want to get life insurance, but you end up having different health conditions now, pre-existing conditions is what they call them. And now the insurance company is either going to charge you an arm and a leg for life insurance, or they're not even going to approve you at all. So those are the main things that end up happening. Or you just don't end up getting life insurance at all, because you're like, I don't need it. So that's really what happens within our community. So I will tell you that when it comes to our parents, grandparents, and et cetera, it was just simply the lack of education that stopped us from getting life insurance, which could have changed all of our lives today. So, and that's the reason why now in 2021, we have the awesome opportunity of sharing this information that I'm talking about today. Like I said, my word of the year is keeping it simple, sharing simple information to create multi-generational wealth. So I will tell you though, if our parents and our grandparents did have life insurance, all of us, everybody in our generation today will be living a completely different lifestyle, completely different. Now, of course, again, with money comes responsibility, because of course, if my son receives $1 million and he doesn't know what to do with it, it'll probably leave his hands faster than he had it. Yeah. But I'm not going to lie though, still having the resource available, come on. I'd rather have the resource than to not have it and not have the education either. I mean, like you don't got both. Yeah. A lot of us were born without either. I'd rather my son have at least one out of two, and my goal is to give them both.
Yeah, that's really good. I have a question, because you just hit on individuals that work a job and they have a policy through it. That is an individual like my mom. That's her situation, and I'm not well versed in life insurance. So can you just share with me like information I can tell her, or her even watch this podcast, so she knows like why you should have a policy outside of your job, because I want to retire her. So if it's not beneficial for her to have it through a job, what should she do? Got you. So let's talk about having insurance through your job. So for most people, they normally get insurance through their employer, right? And that's called a group life insurance plan, which I prefer everybody have their own separate policy outside of their job. Here's the reason why. When you get insurance through your employer, first things first, that's a group life insurance plan, meaning that you don't own the policy. Your employer owns the policy. You get a certificate of insurance, right? So, and since you don't own the policy now, here's the first reason why you should always have a separate policy outside of your job. Since you don't own the policy, you don't have the ability to make adjustments to the policy, right? So basically the employer is the one who's controlling the maximum amount of death benefit that you're going to receive. They maybe control the different benefits that are being received inside of this policy, the company that you choose. So none of these things are really up to you. It's up to the employer, because they're the ones who own the policy. That's first. So you don't have the ability to make those adjustments, which are very important. Secondly, is that when it comes to an employer life insurance policy, what ends up happening is if you leave your job, or the company gets shut down, or you get laid off, 9 times out of 10, you're going to end up losing your insurance. So normally what happens with employer life insurance plans is that they pay a certain percentage of it, and then you pay a certain percentage of the life insurance. You leave the job now, you're no longer in that group, right? That of life insurance. So now what happens is the policy is either going to lapse. Sometimes you're able to transfer it to your next employer, but the policy either lapse or you're going to end up having to pick up the entire cost of that policy, which sometimes people can't afford because, again, you don't control the cost. So it ends up lapsing. So when you leave your job, you no longer have insurance.
Okay.
Right. So, and then the third thing is most life insurance policies through employers are term life insurance. And I was just talking to a client yesterday, and normally the maximum amount that you're going to get is up like $50,000, which $50,000 is not nearly enough insurance for anybody. That's like bare minimum. And that's another reason why getting insurance through your job is not enough, because if they're only insuring you up to $50,000, you are supposed to have at least 10 times your annual income, which we could talk about that in a second. So 50,000 is nearly enough for anybody, regardless of where they work, especially if let's say the average salary is 30,000, 50,000 is nowhere near 10 times. So that's why you always want to have a separate outside policy, one you can control, one that you can get enough to make sure that you're covered, and it doesn't lapse if you end up leaving your job. Okay. So I always recommend always getting a separate outside policy for yourself.
Okay, cool. Thank you.
So when we talk about, that was actually the first time I actually got offered life insurance, when I was at my job.
Yeah.
I remember I got it on me and my daughter as far as the policy. I never really even thought about it, getting it outside of the job, because I felt like I was covered. Or actually, I was actually uneducated at the time, because it's first time, life insurance, cool. Like it comes with it. Oh, it's great benefits. You know what I mean? So what would you like? What am I supposed to try to consider when I try to jump into getting a policy? Like, I really don't even know what to look for. I don't even know what to value myself, or what should I leave behind? Because to me, $1 million sound gravy. You know what I mean? Oh, I'm gonna leave my daughter $1 million, and you said what, $80 for the 30 years. That sounds gravy to me. But that might not be everybody's situation. So everybody has to kind of evaluate their life and where they're at, how much they need, how many kids they actually got to leave money behind for. So how would you even start to evaluate that?
So the rule of thumb when looking for life insurance, when starting out, you always want to, rule of thumb, get 10 times your annual income. That's just the basis, right? 10 times your annual. So for example, if your annual income is $100,000, 10 times your annual would be 1 million, right? So you want to get $1 million worth of insurance. Now, here's the concept behind it. Basically, now, if I have $1 million policy, and at that $1 million policy, and I leave that to my beneficiary, which is my wife, right? Remember, the reason why you want to do that is because I'm 26 years old right now. If I get a 30-year term life insurance policy, 10 times my annual, that means that it's going to cover me from 26 to 56. Now, the point of that is because I'm normally going to be in my high working years between 26 to 56. Yeah. Which means that I'm also at the most risk at that time too. Right. So if something were to happen to me between 26 to 56 and I'm making $100,000 per year, if I pass away, now that $100,000 just evaporated from the household, right? Yeah. Now, normally if you pull $100,000 from a household, that could cripple a home, right? Like literally sell your house, cars got to get sold, credit cards going into collections. Like this happens to people on crazy levels. So you want to get 10 times your annual to be able to cover. Essentially, the way I look at it is, if I got $1 million, something were to happen to me, my wife could literally draw 7% a year. 7% of $1 million a year is $70,000. So if she were to draw $70,000 per year to start supplementing that income that was originally supposed to be coming in from me, then that would last her roughly about 14 to 15 years of income with me being gone. Does that make sense? Yeah. So if something were to happen to me today at 26 and I got $1 million, then she pulls 77% or 70,000 per year, then now that'll cover her to me being age about 40. right? So that's the reason why you always want to do rule of thumb 10 times. That's at minimum that I like to call it, because again, when you're looking at insurance, you also want to look at it like it's a portfolio. So 10 times, normally what I do is I get a term life insurance policy 10 times my annual income just for income replacement. So that's one of the ways that you can get a life insurance policy, for income replacement. And you would get a term life insurance policy for that. But then when you're looking at your portfolio, as your life begins to change, you have to continue to change your insurance, because it's not just a one size fits all approach. So for example, let's say that later on in the next 3 years, I go and get a mortgage, and that mortgage is $500,000. Well, I want to make sure if anything happens to me that mortgage is covered too. I don't want to use the $1 million policy that I have for income replacement to cover for that mortgage if something happens to me. That's meant for income replacement, right?
Yeah.
So I want to now get a separate type of policy, which is another term policy, term life insurance policy, specifically for $500,000 to cover me during the 30 years of that mortgage that I'm paying. So if something were to happen to me, that $500,000 goes to pay for the mortgage. Now family is debt free. They have a house. They only got to pay property tax, and then another $1 million for income replacement that would have originally been coming into the household had I been alive. So what a lot of people don't realize is that you can have multiple life insurance policies for different purposes. You can have one for income replacement. You can have one to pay down your debts if something happens to you. Some people do it for estate planning. Some folks do it to create a savings fund for their children, college education. Some folks do it to grow their assets. So again, the starting point though, to get back to the starting point, the very first thing I talk to every client about is we need to start with making sure you at least have a term life insurance policy for income replacement. That's the first goal that we want to achieve. Because if we don't do that, then you're leaving your family wide open. And most people need 2 incomes in order to survive. So that one income is gone, you're leaving your family exposed. We have to cover that part first.
So a question I have based off of what you guys have just talked about is, okay, say for instance, I'm at the stage of my life where I'm not married. I don't have a husband. I don't have kids. So why should I get life insurance, or like, how can I plan for the family I have yet to have by getting life insurance?
Got you. That's a great question. So that's really a question that a lot of younger individuals, even around my age, 26 and under, have. What I do say about getting insurance when you're younger, it's fairly cheaper to lock in a policy at a younger age, knowing that you're going to have a family in the future.
Right.
So the way that I look at it is, if you're how old? 23 years old. I will tell you now, not even pulling a report right now, even if you were to get a $500,000 term life insurance policy that just ran you for 30 years, because you know within the next 30 years you plan to have a family and children, right?
Yes.
If that's on your goal list, I would lock in the price now at a younger age while you're still healthy at that, and you could probably end up getting that policy for $20 a month.
Oh, wow.
But remember, one of the things and this is why I say for younger folks, at least lock in a term life insurance policy while you're younger and get it for 30 years out, because you know your life is going to change. Lock in the price while you're healthy, lock in the price while you're young, and it's a guaranteed price for 30 years. It's guaranteed. So that's highly important. And one of the things I say all the time is that creating generational wealth is cheaper today and more expensive tomorrow. And the reason why I say that is because every single day that you get older, if you don't continue to take the steps of building generational wealth for your family, even when they're not even here today, as a younger individual, it's going to cost you later on regardless. So even if you decide not to address it now as a younger individual that doesn't have children and a family, you're going to have to address it in 10 years. So I'd rather do it now, lock it in now, knowing that I'm going to have to see it in 10. Does that make sense?
Yeah.
So that's what I say. And I would always just say, start off, if you don't have a family or anything, start off with a term life insurance policy because it's cheaper, and then lock in a low price, like $20, $30 a month, guaranteed out for 30 years. And now you have that covered. And then regardless of the fact if you don't have a family now, you make somebody else in your family the beneficiary at the moment while you don't have any children or husband or wife, right? Okay. Lock it in, put somebody else in the family that you trust. And then when you have kids, you always have the ability of switching over your beneficiaries.
Yeah.
So you can do that. I think though, what's important, because a lot of people are listening to this podcast and they're like, well, Don, what's even the difference between term life insurance and permanent life insurance? We got to address that first, because I've gotten that question a lot of times in my DM. Don, what's the difference between term life insurance and permanent life insurance? Let's break it down very simple. Term life insurance sounds exactly like the word. It's a term. So I want you to think of term life insurance like renting an insurance policy. So the insurance company is going to come to you and say, hey, we're going to give you $500,000 or $1 million, or for example, myself, we're going to give you $1 million of life insurance, but this $1 million is only going to last 10, 20, 30, or 40 years. At the end of that 10, 20, 30, or 40 years, it's going to expire at that point, right? It's going to expire. So you're just renting it for that time. But because you're renting the term life insurance policy, it's cheaper to have a high death benefit. What is your death benefit? A death benefit is how much the insurance company is going to pay out in the event that you die. So if I have $1 million death benefit, that means that if I pass away, that $1 million gets paid out to my son and my wife within 3 business days. 3 to 5 business days. That's the death benefit. And in exchange for that $1 million death benefit, I pay the insurance company every single month, let's say somewhere between 30 to 50 bucks. Sometimes it could be 80 depending upon the policy. Mine was, I think, $70 or so. And I pay that every month for the next 30 years. And after the end of that 30 years, that term life insurance policy expires. You have the ability of converting a term life insurance policy over to a permanent insurance policy. I normally don't do that, but after a set period of time, the term life insurance expires. That's the reason why it's the cheapest type of policy that you can get. Okay. Then you also have permanent life insurance. There are different types of permanent life insurance policies. I got to go into an entire podcast just on the different types. There are a ton that I can go into, but you have whole life insurance policies. You have index universal life insurance policies. You have, there's a ton that I could go through, but permanent life insurance, the concept of it is it's meant to cover you for your entire life. Term is only covering you for a certain term. So when you get permanent, it covers you all the way up until death. And then when you die, it'll pay out the death benefit to your beneficiaries, which could be your wife or your kids or whomever they may be. But that doesn't expire. So permanent life insurance ends up being a bit more expensive because it's covering you for your entire life. Now, you have some people who don't agree with permanent life insurance because some people believe that you're not supposed to have, you shouldn't need insurance for your entire life. My opinion on permanent life insurance is that I fully agree and believe in permanent life insurance. I think that the people who write permanent life insurance policies, the agents who write them, are not educated enough to structure the permanent life insurance policy the right way to make sure that you're not paying through the roof when you get older. So just to break that down again from a permanent life insurance standpoint, here's the difference of why permanent life insurance is a lot more expensive. To keep it simple, permanent life insurance has what's called cost of insurance, right? So as you remember, when you get term life insurance, you're locking in a price for the next 30 years that's never going to change. So if you're 24 right now, they're going to lock in that price at age 24. They're not going to change it again just because you're 34 and you're unhealthy now. You locked it in at 24. That's the reason why getting it at a younger age is so important. You're locking in the price before your age and your health changes. With permanent life insurance now, you're not locking in a price at 24. Every year that you age, the cost of insurance begins to increase with permanent life insurance. So, for example, my cost of insurance in year 1 could be $200. My cost of insurance in year 10 could end up being $1,000. My cost of insurance in year 20, which would make me 46 years old, could be $1,200. My cost of insurance, like as I get older, and then what ends up happening is when I become 65, 70 years old, if I have so much permanent life insurance that's available to me, then my cost of insurance now is literally through the roof. And now at 70 years old, your cost of insurance could be $8,000 per year, right? Now, one of the things that permanent life insurance does have, the benefit of it is it has a cash value. And basically, it's like this forced savings account that you have. So when you look at permanent life insurance, essentially, let's say that my payment is $200 a month that I'm paying for permanent life insurance. When I pay that $200 per month, a certain percentage of that payment is going to go towards the cost of insurance and the maintenance and the fees that are associated with that insurance policy. And then another portion is going to go towards this savings account that the insurance company has available in that permanent life insurance policy. So if it's $200, let's say that your cost of insurance plus maintenance and everything is $100, and let's say that the other $100 goes towards your cash savings account. I'm gonna keep it simple, numbers. So now every time that you pay your policy, that's what's happening to your premium. A certain amount is paying for the policy, the other amount's paying towards this cash savings account. And now you're building up what's called a cash reserve. So now as the years go by now, this cash reserve is earning interest. And as it's earning interest, you're now growing money in this cash reserve. Here's the beautiful part about it. You get to a certain age now, and let's say that you need money. We know historically that people have less than $1,000 in their savings account. So we know that for most people, they're not going to save on their own. They need a forceful way to save money, right?
Right.
That the permanent life insurance gives that forceful way to make you save because it's out of sight and out of mind. You're paying your insurance, and a portion of that is going towards a savings account really without you knowing. And it's earning some interest. Now you get to a certain age and you're like, hey, I need money. I ran into an emergency. Now that money that's been going towards that cash savings portion of your life insurance policy, plus the interest that's being earned, you're able to now draw money from that cash savings account. Now, from a tax, so I don't overcomplicate this, we all know that whenever you make money in this world, what happens?
Government need a piece.
And that's called what? Taxes, right? So whenever I make money, I have to pay taxes on that money.
Right.
Now remember, let's say that I put $5,000 towards my cash savings account in my life insurance policy. $5,000 went into there. And let's say that I earned $1,000 in interest off of my 5Gs.
Yeah.
Then how much what amount am I paying taxes on? Paying taxes on the $1,000 that I earned.
Right.
$5,000 was mine. The $1,000 I earned in interest, I made money. So I got to pay taxes on $1,000. Now with life insurance, the beauty is you're able to take what's called a policy loan. You're loaning money from yourself. And through taking that policy loan, you're able to bypass the taxes that you would have had to pay on that extra $1,000 or more because you're loaning money to yourself. When you loan money to yourself, you don't pay interest on the loan. For example, if I go into a bank right now and a bank were to loan me $15,000, am I paying taxes on that $15,000? No, but they technically gave me 15 grand. That could be considered income that I got. But since it's a loan, I don't pay taxes on the 15K.
Because you gotta give it back.
Because I'm giving it back.
Right.
Essentially, with insurance, all the interest that's being earned, I'm able to loan that to myself. And by loaning it to me now, it's essentially, since it's considered policy loan and I have to pay it back, I don't got to pay interest on any of the growth. So you're probably saying to yourself, well, when do I have to pay it back? Well, technically, the insurance company is not going to require you to pay it back.
Oh, wow.
As payments. What would end up happening is you could have a policy loan that's running on your policy, right? And let's say that your death benefit is $500,000 and you took a policy loan out for up to $250,000. What would happen is when you passed away, they would subtract that $250,000 from the death benefit. So now
when you pass, instead of your kids or your beneficiaries getting $500,000, they're only going to get $250 because you took the other $250 as a policy loan. Does that make sense?
Yeah.
Yes.
So you don't have to necessarily pay it back.
So in essence, you're like your own bank.
In essence, you are your own bank. With permanent life insurance, in essence, you are indeed your own bank. You are self-funding yourself plus interest, and then you're able to pull policy loans out of that policy tax-free to be able to utilize to invest in starting a business in real estate. One of the interesting stories that I just heard about with Earn Your Leisure was Walt Disney actually did that. Wow. That he used the funds from his permanent life insurance policy to actually be able to fund the business because he couldn't get a loan traditionally from the bank. So this is, yes, a permanent life insurance. If structured the right way, you can use this as a form of your own bank and earn interest from that, and then pull loans out, bypass the taxes, and you still get the death benefit if something were to happen to you.
Wow.
That's the part that a lot of people don't know. And this is why they call life insurance the rich man's game, because if, again, you structure it the right way. Now, let me tell you the tragic story behind this, right? Let's talk about the tragic story behind permanent life insurance. The reason why permanent life insurance gets a bad rap, and you probably heard folks like Dave Ramsey and other people talk about the fact that permanent life insurance is basically, it's a scam by the insurance companies and you should never buy it. The reason why they say that is because what ends up happening is, normally when you're going to get permanent life insurance, as a consumer, you were trained to believe, I want to pay the lowest amount possible for the highest amount of insurance. Yeah. So when you call the insurance company, ring, 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 hey, what's going on? I need permanent life insurance. Guess what the insurance company is going to do? They're trying to be competitive, and they also know that you're trying to be cost effective. Mm-hmm. So what they're going to say is, okay, cool. All right, looking up your name, your date of birth, your health profile, and where you currently live. All right, cool. For $100 a month, I can, based off of your age, I can get you $700,000 worth of permanent life insurance. Today, with you being age 24, I can get you that $700,000 for $100 a month today, right? So now you like, great, yo, that's huge. They're trying to be competitive, so they're giving you the lowest cost necessary. Now, remember what I said about permanent life insurance. There's a certain thing called cost of insurance. So with permanent life insurance, your price is not guaranteed. As you get older, the cost of insurance continues to increase. So you're 24 today and you paid $100 and your cost of insurance is low. When you're 44 now, your cost of insurance has increased because you're older now, and it's more of a risk to the insurance company to insure you at an older age. Mm. So now as you get older and older and older, the more death benefit that you have available to you, right, compared to your cash value that you have, the more death benefit you have available to you now, the insurance company looks at it as a risk, and now your cost of insurance begins to increase and increase and increase and increase. So what ended up happening to a whole bunch of Americans is that they get 75 years old, they have so much permanent life insurance available that they don't need. So now their cost of insurance is $8,000 now. And what ends up happening is, here's what the insurance company does when you have $8,000 worth of cost of insurance and other fees. They're going to do one of two things. Remember that cash value I was telling you about that you built up?
Yeah.
Now they're going to try to pull that $8,000 from the cash value. They're going, because they need their money every year, right, to keep the policy in place. Right. So they'll start pulling the $8,000 from the cash value. Let's say you got $100,000 in cash value. Every year they're going to pull $8,000. Then again, next year, cost of insurance got increased. Now it's at 10. They're going to pull $10,000 next year. Before you know it, what ends up happening is your cash value is going to get depleted by the cost of insurance. So now once the cash value gets depleted, now you only got one option here. That one option now that they can't pull from the cash value, you now have to come out of pocket to pay for that policy for the year. If you can't pay the policy for the year, then guess what happens?
You don't have
the policy lapse. Once the policy lapse, guess what happened? You lost all of your cash value and you lost the death benefit. Now you have no insurance. Your heirs, your family, they get nothing. So all that money that you just paid into that insurance policy for the past 50 years, gone. The insurance company basically got a one-up on you. They won. Yeah, totally legal too to do. They won.
here's the issue. And why I still believe that permanent life insurance is still one of the best forms of policies to get. The issue was that a lot of insurance agents were structuring the policies all wrong. Again, since you came in with the consumer mindset and you tried to get the most amount of insurance for the least amount of money, you weren't considering how much it was going to cost you when you turned 60. So one of the things that I do with a lot of clients is we like to work it backwards when it comes to permanent life insurance. Instead of you going and saying, I want to get the maximum amount of death benefit for the cheapest amount of cost, what we're going to do is we're going to say, no, we're going to get you the lowest amount of death benefit based on how much money that you can pay. So for example, I'll give you an example because that might have been like, hold on down, what you're talking about. Let's say that Van, you have $100 to pay towards permanent life insurance. I'll say, okay, great, Van. For that $100 that you can pay towards life insurance, let me figure out what's the minimum amount of death benefit that you can receive. And you're probably like, what do you mean the minimum amount of death benefit? Well, the IRS has laws that are in place. I think it's TAMRA, TEFRA, and DEFRA. There's laws that are in place where in order for a life insurance policy to be considered life insurance, you have to have a minimum amount of death benefit based on how much you're paying into the policy. The reason why is because you have people that were investors, right? Remember we talked about the fact that you get your life insurance, you can bypass tax-free. You can get all that growth tax-free. So what do you think a lot of investors did? They would go to the insurance company and say, hey, I want to get a life insurance policy and I want my death benefit to be $10,000, but I'm going to pay $50,000 a year into the policy. So now your death benefit, 10 grand, your cost of insurance is mad low, but you're putting $50,000 a year into the policy. Then that $50,000 is earning interest. So now you earning interest in this policy. And then all that they did was they pulled policy loans from the policy to take all of the growth. They bypassed the IRS and all the taxes. So smart people did that. The IRS stepped in and said, nah, we can't do that anymore. You're running this like it's an investment. So if you are going to run this like it's an investment, you need to be taxed like an investment on every dollar that this policy grows on. So they put rules in place where now if I'm going to pay, let's say $200 a month into this policy, here's the minimum amount of insurance that you have to maintain at this $200 price point, which $200 will come out to be about $2,400 a year. If you pay $2,400 a year, here's how much insurance you legally have to maintain in order for this to be considered life insurance and not to be considered an investment. Does that make sense?
Yeah.
So now what I would end up doing is I would run a policy for you where for that $2,400 a year or $200 a month, I'm going to get you the minimum amount of death benefit that you can possibly legally receive. So let's say for that $2,400 a year, the minimum at your age is, I'm gonna just throw a number out there. Let's say it's $200,000 or somewhere. That's the minimum I can go. I can't go any lower than that where it's going to be considered an investment. Now what happens is by me giving you the minimum amount of death benefit, and you're like, damn, but I need the death benefit to be high. Wait a second. By me giving you the minimum amount of death benefit now, remember we talked about cost of insurance, right?
Yeah.
By me keeping you at the minimum, I'm keeping your cost of insurance and your fees very low. By me keeping your cost of insurance and your fees very low, remember you're paying $200 a month. Remember we talked about how a certain percentage of that is going towards paying for the cost of insurance and the fees, and the rest of that is going towards your cash value, right? If I keep your death benefit very low, then what happens is now more of your premium is going towards your cash value savings account, and then the lesser of the premium is going towards paying for the actual cost of insurance. So now what I'm doing is I'm putting more money inside of your cash value. I'm pushing as much as I possibly can while keeping the cost of insurance low because you're not carrying a high death benefit.
So essentially, maybe your cash value can also be $200,000.
Exactly. Now hold on. Now you're on your way. You just beat me to it. Let's talk about that. You just literally beat me to that concept. You literally beat me to that concept now. That is the exact strategy where we want to get. Your death benefit now is $200,000. We want to try to put as much cash value into this policy as we can to be able to get it to reach that $200,000 threshold. Now, by us doing that, remember, it's earning interest at the same time. So here's what happens. When your cash value is literally almost right around the same amount as your death benefit, here's what happens. You've pretty much self-insured yourself. So now your cash value is $200K. Your death benefit is, let's say the legal minimum that they put it at is at, based on $200,000, your legal minimum that you got to carry is, let's say, $240,000. That means the insurance company is only at risk for $40,000 because you self-insured the other 200 and something thousand that's in your cash value. So now your cost of insurance at age 60 years old is nothing. Your cost of insurance is nothing. It's literally like the same 60-year-old who's paying $8,000, $10,000 a year in cost of insurance. Since you went and got the minimum amount of life insurance and you wanted to put as much as you could into your cash value, now you're no risk to the insurance company because you self-insured yourself. And now at 60 years old, they're paying $8,000 because they were given the wrong information. And at your 60 years old, your cost of insurance is literally a couple hundred, like maybe $200, $300, $400 a month. A year. And watch this. You don't got to come out of pocket because the cost of insurance will get paid for from the money that's in your cash value. So remember, your cash value is earning interest. So now your interest is paying for the policy. So if my interest that I'm getting, let's say I'm getting 5-6% a year on that $200,000 I got. Well, what happens is now from that 6% I'm getting a year, they take a certain amount out from the interest, pay for the policy. The rest of the interest goes towards the cash value. I literally have a policy that I'm not coming out of pocket for. I know I don't got to think about paying it anymore. So I now have a death benefit that's free. And I also have cash value that I can pull from at any given time as a policy loan and bypass the taxes. But what happened was agents were not educated enough on how to structure this the right way, which I know how to structure it the right way. I've done it for a couple of our clients already. And by the way, you got to go to a broker in order to do this. We structure that permanent life insurance policy the right way. And we do it as I like to call them index universal life insurance policies. We structure it the right way. Then you're going to be able to have a really big cash value, a very nice death benefit setup, and bypassing the taxes if you go ahead and pull a policy loan from it. And then we keep your cost of insurance very low too. Bingo. That's one of the ways that wealthy people push a lot of their money. That's one of the ways wealthy people are able to bypass taxes and start pushing their money into policies. So what just to end this off, what a lot of wealthy people would do is they'll say, okay, cool. I got an extra, not even wealthy person. Let's just say somebody who sitting on $20,000. I'm sitting on $20K. I got some extra money. All right, cool. Here's what I'm going to do. They'll call me and say, yo, Don, look, I got $20K. What can I do as far as life insurance? All right, cool. Like we talked about before. Okay, with this $20,000, if we were to put this as a premium into your life insurance policy and you just write one large check to the insurance company to pay for the premium, what I'm going to do is for that $20,000, how much is the legal minimum amount of death benefit that I can give you for that $20K? So let's say for that $20,000, the legal minimum, I don't know, let's call it couple $100,000. We want to keep it at the legal minimum. Now out of that $20,000, now that goes to work immediately because his cost of insurance stays low. It goes straight towards his cash value. His earning interest is growing. He pulls back the policy loans, tax free from all the growth that it earned. Walk away. That's it. And that's one of the ways that it's done. One of the ways. So my thing is life insurance is a great piece to add to your portfolio, but you should have multiple things in there, right? Yeah. So life insurance is one of them. I think it's the foundation and it's the easiest way to transfer wealth. But I also think, having a brokerage account set up when it comes to in the stock market, right? Having your IRA set up, your traditional or your Roth IRAs, having 401k set up if you have one through your job, like getting all of these different things established you know, those are all important because they all work collectively together in order for you to have financial freedom. And everything that I'm talking about right now, by the way, these are all simple things that the everyday person can do. I did not say one thing right now where you had to be some high level genius in order to do this. Number one, if you don't know how to do that as far as life insurance, that's why you have us as brokers at Jack Life. We can structure that for you, and we can get you life insurance very simple. There is a ton of different people on the internet that talk about investing in the stock market, and there are a ton of different courses that are out there. By the way, shout out to my guys at Earn Your Leisure Market Mondays. They have literally free classes every single Monday night breaking down the stock market. So there's no excuses for you there. And then you can easily contribute into your 401k plan at your job if they offer it. Or you can set up your own IRA at the, with the online broker at the bank or somewhere, traditional or Roth. All simple strategies that you can utilize in 2021 to be able to create financial freedom for yourself in the future. The issue is that most people don't do it. They don't do it. And that's the problem.
I'm going to need you to say that in 30 seconds after we wrap this up.
I do have one more question. How many life insurance policies can a person have?
As many as you want based off of need. Okay. So what I mean by need is that one of the things that I do when sitting down and talking to clients is we run what's called a needs analysis. By running this needs analysis, very simple, we find out how much income that you have. So then we can create some type of income replacement. We find out how much debt that you have. And then we also look at your future to see what are some of the things that you want to do in your future. And then we look at some running costs such as burial expenses and different things of that nature. And then we'll start to graph what's called a needs analysis. And through running that needs analysis, we'll base how much insurance that you need today. But it's important to remember that within the next 2 to 3 years, you could have completely different needs. Like I talked about, your debt could change. You could have more kids. You could have gotten married. You could have moved to a new location. Your income could have increased because you got a bonus at your job, double your income. So now we got to do a whole different needs analysis. Or your goals could change. Maybe you have some money set in savings account that you're not using right now that's not earning any interest. So now you need a place to put that. So there's no cap to how many life insurance policies that you can have. Remember, it's like a portfolio. There's no cap to the amount of stocks that you can own, right? You can own as many as you want in the stock market based on your goals and your portfolio, right? So it's all based upon that need. And then with life insurance, we fill those needs through life insurance policies and structuring them the right way. You could have a 10-year term. You could have another 30-year term, a 20-year. You could have a permanent life insurance policy. You could have another one that's an index universal. We could put together all different types of things in your portfolio. And you could have about 10 different policies, all for 10 different things. You know, but you don't want to get overinsured either, which you just got to be careful of. And normally if you're working with the right broker who's in your best interest, they will make sure you're not overinsured, that you have enough insurance to cover those needs and those areas of opportunities for you. But there's no cap to the amount of insurance policies that you can have.
Great.
No cap to it.
So I got a question because some of us actually have adults in our lives that are not responsible, you know, who don't really believe in life insurance or anything like that. How do we go about getting them a policy? Is it the same way you actually do for your kids? Yes.
So let's break this down. I was actually just talking to a client the other day, and he said that he wanted to get a life insurance policy on his 70-year-old mother and his 82-year-old father. And I told him that was the best decision that he could have possibly made, because I don't understand why, as younger folks, we don't take policies out on our parents and our grandparents, knowing that they're headed towards the end of life and they can make things way easier for us when they pass, because it's a guarantee that it'll happen. So my thing is, you definitely should take out a policy on mom, dad, and grandparents if you can. It will be a bit more expensive for you to do it, but here's the way that it works. Basically now, it's a certain thing called insurable interest. Okay, so I can't just walk down the street and just get insurance on anybody. Like, I can't just go to you, Bianca, and say, I want to get insurance on you, right, and I'm going to bet on the fact that if something happens to you, I'm up. Right. I can't do that. Right. You know what I'm saying? Right. The insurance company will never do it. You need to have insurable interest. So normally insurable interest works between families, parents, children, and business partners too. I could go to a whole nother segment about that with business partners. So what happens is now that I have insurable interest between my parents and my grandparents now, I can become the owner of the policy. I'm the one who's applying for it, and I'm the one who's paying for it, and I have the ability to make the adjustments. Like we talked about with the group life insurance policy, how your employer is the one who owns the policy. You're the one who's insured. You're the one that's the owner of the policy, and your parents and your grandparents are the ones who are insured. So the price will be based upon their health and their age at the time, right? So you're insuring them. Of course, you're still going to have to let them know that you're insuring them, but you should sit down and have that conversation with mom, dad, grandparents and say, hey, look, I don't even know if you have insurance or not right now, but listen, look, let's sit down. We're going to get the family together or something like that, or a couple of us, or me. I don't even care. I'll pay the premium. If it's $300 a month, I'll pay it. And I'm gonna make sure that this is paid for, because it's inevitable that you're gonna pass, and we want to make sure that burial expenses are taken care of, and more importantly, we want to make sure that some sort of generational wealth is transferred down as much as we can get, as much as you can afford. There are insurance carriers that we work with right now, that I work with as a broker. There are carriers right now that will insure older people up to I think 85 years old. Promise you they will. It's going to cost. And of course, there are certain barriers to that, and they're not going to allow you to get $1 million policy out on a 75-year-old. That'll never happen. But you can at least get something to create some sort of wealth transfer, even if it was $50,000. Yo, do you know how much different that would be for your parent to die and you got $50,000 sitting inside of your account? You know what you could do with 50 bands?
A lot.
It's more than what we got now, right? So with that said, I definitely agree, and I think that it's a great investment to make into your family. So, but it starts with having a conversation with them and getting real and saying, hey, look, you're going to leave us in a bad financial position if something happens to you. So you got to sit down and have that financial conversation with mom, dad, grandparents. But I was literally just talking to a client, and we just got insurance on him, and now he wants to get insurance on his parents too. And we're now working on that case right now to make sure his parents have insurance. He's going to be the owner. They're going to be the insured. And we're going to have that closed down probably within the next 2 or 3 weeks. Just had that conversation. So that was a great question. That's a great strategy for everybody. Great strategy for everybody.
You got any more questions, Bianca?
No, I don't have any more questions.
Yeah, you pretty much slayed that.
Yeah.
Is there anything else that we should probably know before we consider life insurance? I mean, it seems like definitely actually, I do have a question.
Yeah.
Well, I think you probably already answered it. It's more about obviously those people who actually do have health issues trying to get a life insurance. Obviously, the insurance companies are going to kind of rank up the price a little bit because their chances of leaving earlier or higher. Am I right?
Yeah, that's a good question.
So basically, when it comes to life insurance, there's a few different things that you want to pay attention to when getting a policy, and I'll answer that question there. The first thing you want to pay attention to is the financial rating, the financial strength of that life insurance company. Before I get any of my clients with an insurance carrier, I want to make sure that they have a strong financial backing, because believe it or not, 30 years is a long time from now. And let's say within that 30 years, something were to happen to you and that insurance carrier is not able to pay out that policy because they didn't have the cash reserves to pay for it within going into that 30-year period, or they just didn't make sound investments and they were messing up money. That happens to people all the time. That's the reason why I always recommend that, like, when you see ads online saying you can get up to $1 million of insurance for as little as $15 a month, be very careful and make sure that you're looking at the financial strength of the insurance carrier. Just because they can get you $1 million for 15 doesn't mean that they're going to be able to pay out that $1 million in the future if something happens to you, right? So be very careful. I always look for strong financial backings when it comes to the carrier. We have about access to 35 different carriers that all have strong financial backings. That's number one. The second thing that you want to look for an insurance carrier, especially when looking for term life insurance. You want to look for a term life insurance carrier that has living benefits. Now, this is another reason why when you see these ads online that says you can get $1 million of life insurance for as little as $15 a month, the reason being is because the thing is, the policy, the price is probably good, but the policy is probably trash. And one of the things that we do as consumers, again, we try to go for the best price, but sometimes the best price in life insurance is not the best thing that's for you, right? Sometimes paying a little bit more will save your life, literally. And I'll break this down. Why is living benefits important, and why you want to make sure that that's the second thing that's on your list when looking for an insurance carrier? The reason why is because we all understand that life insurance is good for death benefit, right? Yeah. We all know that. We all think about that, right? But what about you living too long? Because life insurance is for when you die too soon, but what about living too long? Living too long means, okay, what if I end up having some sort of chronic or critical illness or some type of critical injury? Mm-hmm. That happens. We can't act like a lot of people don't have cancer, heart conditions, all types of stuff, right? That's a real thing.
Yeah.
We all know somebody that end up coming down with some sort of severe condition in our families, right?
Yeah.
So what happens when they get hit with a severe condition, and now they have medical bills that are through the roof that they can't pay? What happens now?
People usually go in debt.
Not even debt, bankruptcy.
Yeah.
It happens. Like house gone, car gone, everything.
It's like the highest reason for people to go in debt.
That's one of the main reasons why middle class families gone. Yeah. Because of medical bills. It ruins your life. And then you have health insurance, but health insurance is only going to cover up to a certain amount. Yep. So the remainder gets billed to you, ruins you. Hospital don't care either. They want their money. So that's why now with living benefits, this is important, because let's say I have $1 million life insurance policy, which I'll give my exact example. I have $1 million life insurance policy. I have living benefits, which means that if I come down with any type of critical or chronic illness or critical injury, depending upon how severe it is, based on the doctor's diagnosis, the insurance carrier will pay out up to 90% of my death benefit to me while I'm alive. While I'm alive. So if it's $1 million, I can get, depending upon how severe, if it's like life threatening, they could probably pay me out up to $900 plus $1,000 check to me in my hands right now that I can utilize. Not when I'm going, now. So I can make sure medical bills taken care of, making sure that if I need the right type of care, maybe you got to go into a nursing home. That's expensive, right? Maybe like all of those things. Now I get a check while I'm alive, right? So you want to look for a company that offers living benefits when you get into term life insurance. That's number 2, right? And then the third thing that you want to look for after that is, to your point of the question that you asked, underwriting. That's the part that's most important here. You want to look for a life insurance carrier that has what's called loose underwriting, or what I like to call express underwriting. What that means is, and a lot of people didn't believe me, I was able to get $1 million term life insurance policy without any blood work, without any urine samples, no medical evaluations, no phone call, nothing. I was able to get it within 3 days. Why? Because the carrier that I went with has very loose underwriting requirements. So what happens is, now I like to look for carriers with easy underwriting, for the most part, easy underwriting, where they're not going to go into this entire process where they're doing an investigative background on you. They're pulling your urine. They're doing blood samples. They want to see your all types of family history. And that could get like exhausting. And more importantly, they may end up finding something and then they end up denying you. So if you go with more of a company that has looser underwriting, it makes it easier. And that's the reason why when it comes down to like family, like mom, dad, and like your grandparents, and even for yourself and children and everything like that, you will go with a looser underwriting. It makes it easier for the process to flow through and not have to get it long and drawn out. So those are the main 3 things that you want to look for there. You want to look for a strong financial backing. You want to look for a company that has living benefits. You want to look for one that, for the most part, has looser underwriting requirements. Those 3 things are golden. And we were able to do that for all of our clients. And now that's why we're able to get these policies through, because we got some really good carriers that do all 3.
That's crazy. I'm just sitting here thinking, if only the government made life insurance mandatory, like my car insurance.
Right.
But listen, y'all see how crazy that actually is?
Yes.
And I really want to, like, we got to turn this part into a clip right here. We have to. The craziest thing is how it's legally required for you to have car insurance And then for the most part, you're pretty much sold into having insurance on your cellular device. And I know everybody that's watching this video got insurance on that damn iPhone. And I know you got car insurance unless you're driving around illegally, which that ain't no good. But it's not required. It's not talked about. And it's not even sold to you in any way to understand the seriousness of getting life insurance when that is a guarantee that you're going to die. It's a guarantee. Getting into a car accident, there's no guarantees there, right? Now, of course, I understand why you need car insurance, like for sure. It's the what if, but it's no guarantee. I have not gotten into an accident yet, knock on wood, God forbid, please. I got a son now. Like I don't want nothing to happen to me, and I don't want him to get death benefit no earlier than anything. I want to live to 100 years old. But there's no guarantee you're going to get into a car accident. There's no guarantee that you're going to drop your phone. But all of these things were like, yo, they push to you. You're guaranteed to die, and it's not even talked about. Life insurance is not legally required. It's not talked about. It's not, to be honest with you, how many times have you really heard it being talked about in school as one of those things you must have in your portfolio for financial freedom with your family? How is that possible? Because of the fact that, now I wouldn't even necessarily say the government, but the system in general understands that if all of us were to wake up and we were to get smart, which, by the way, 40-something% of people across I think 42% of people across the United States don't have life insurance. And I think about 70-something% of people are actually underinsured. So if everybody were to just wake up, right? We all in our community right now, the African-American, black and brown community, woke up and said, I'm about to take my life serious because I know something's guaranteed to happen to me. And I'm going to go ahead and get life insurance because if something happens to me, if I can at least get my kids, even if it were 50, 100,000, 200, 300, if I were to give them that would set them up 10 times further than me, my parents, my grandparents, my great-grandparents. If I were to just do that, I can assure you, Van, that within 100 years, our children wouldn't even understand what our lives were like today. I can assure you. They wouldn't even understand. They probably would try to figure out why are we here? They wouldn't even understand. Now, of course, again, like I said, you also have to match that with financial literacy to make sure that if they receive that money, they know the right things to do with it. Yeah. But again, like I said, even if you want to make that argument of, life insurance without financial literacy, well, let's just talk about the fact that most kids ain't getting either. They not getting life insurance or financial literacy. So to keep it real with you, I'd rather them at least have life insurance. And if they're going to have a ball, damn, at least have a ball. You know what I'm saying?
Right.
Something. Because right now it's nothing, right? At least pay off the crib. And then all I got to do is pay the property taxes. At least something. So it's not mandatory because they understand that if we were to wake up, we could change the trajectory of our entire community like that. That one simple concept of life insurance is one of the only things right there. That main thing where you literally don't got to do nothing and something could happen. You don't got to do nothing. Like you got to invest in the stock market. You have to be disciplined enough to take your money and invest in the stock market. You have to be disciplined enough to be able to put money into your retirement account. You have to be disciplined enough to save up your money and say, I'm going to go and buy me an investment property. You got to be disciplined enough to say, I got to get my credit right so I can go ahead and get a mortgage to start paying towards having ownership. You got to be disciplined enough to do all of these things. You don't got to be disciplined to have life insurance. Just pay the damn policy. And I guarantee you something will happen because it's guaranteed to happen to all of us. We don't know when, but it will. And when it does, your family is taken care of. Like, it's a simple concept to me. And that's just for everybody listening to this podcast, that's the main thing I want to get across to you is that I don't really care if you even go through us as a broker. I don't care, to be honest with you. I'm just here to give you the information. Whether you go through me or not, don't matter. We're booked all the way until the third week of February right now. We're rolling. I would hope that you do, but if you could just get this message that literally you don't have to do anything. And this is one of the simplest ways to create generational wealth for your family. If you don't do anything, please just get life insurance. If you don't do anything else, that's all you got to do. That's it. That's it. It's not rocket science. It ain't rocket science, man. It's not rocket science here.
Well, with that said, would you like to close out this episode?
Yeah, so I want to close out this episode by saying that if you're interested in getting life insurance, again, Jack Life, we are a life insurance broker. We have access to about 35 different carriers across the United States, and we can set you up with an appointment so you could talk to one of our insurance agents, so we can go ahead and get you set up. All you got to do is just go to follow us on Instagram. You can go to I think it's Jack Life Insurance on Instagram. Go to Jack Life Insurance on Instagram. Follow us on IG. You can also download the Jumping Jack Tax app. And when you download the app, inside of your client portal, you're going to see a section where you can book an insurance agent. All you got to do is book an appointment with us. And once you book that appointment, you'll talk to one of us, and we'll make sure that you're set up, that you have everything that you need, and that you're leaving some type of generational wealth to your family, and that your debt is paid off, and that your kids, and that your wife, your kids, your husband, they're better off than when you started. So please do that for me. I look forward to talking to you. And for the next month, I'm literally talking to every client on the phone, through our Zoom call when we go through illustrations. So I would love to talk to you to make sure that we get you set up. With that said, this was a great episode, man.
Yes.
You're listening to $1 Million Life Lessons, where we talking about $1 Million life insurance. I'm your host, Prince Donnell. And we right here, man with the cam, right here, man.
Ron Vann Dam.
And our special guest,
Bianca.
We'll see y'all next time.
Jumping jacks, tax, got my taxes jumping, now my bag coming with that major money, dripping blessings, that might buy a house for my mama, bad credit, don't even sweat it, cause they'll repair it, ain't no question, they can do it, it's a major move.